We are going to talk about something that, I don't know, most of us don't necessarily love and enjoy, which is taxes. I believe the more we learn about taxes, the more we understand taxes, the more we can play the game, and the less taxes become an evil and they can become an advantage. So what we're going to talk about today is some basic tax strategy, and then we're going to go into a couple of kind of more higher level tax strategies, and then we'll open it up for some Q&A for you guys. I always do this time of year for obvious reasons. This is the time where most of us are thinking about taxes, when even though the reality is that should be part of our thought process throughout the entire year, right? We should be planning for, and most importantly, strategizing around taxes all year. Yet this is when it tends to be top of mind, because this is when we are approaching having to file our taxes for the year. So a couple things. One, who I am not. So most of you have been joining for a while. You know who I am not. I'm not a financial advisor. I'm not a CPA. I'm not a tax advisor, and I'm not an attorney. So disclaimer, this presentation is for information purposes only. Obviously, you should speak to professionals when implementing tax strategies in your business. So again, I'm not a CPA. I'm not a tax advisor. I'm not a financial advisor. I am sharing information. My intent is to hopefully give you enough information to be able to go and have intelligent conversations with the professionals that you actually need around you in your business and personal life in order to be able to implement these strategies, right? It's really important to have a good CPA, a good either bookkeeping platform or bookkeeper, tax advisor, a financial planner. Those are important people to have in your life. Yet having them does not release us from our obligation to be somewhat educated around these things, right? My experience has been you need to know enough to at least ask the right questions in order to be able to maximize tax strategies. So that's my goal today. So a couple things. Number one, the three pillars, as I look at it, the three pillars of wealth are pretty simple. One is the ability to generate income. Two is the ability to save money. And three is the ability to invest, right? So I always say those are the three pillars of wealth building. And we have to be able to do all three, right? If we know how to save and invest money, but we don't know how to generate income, then we don't have any money to save, and therefore we don't have any money to invest. If we know how to generate income, but we don't know how to save money, then we don't have any money to invest. Right? And if we know how to generate money, we know how to save money, but we don't know how to invest it, then we may be able to pay our bills, but we're not going to be able to build wealth. Assuming we're speaking about wealth from the standpoint of wealth is putting our money to work for us, right? So we go out and work for money. When we shift to the investment spectrum, that's us putting our money to work. Right? And we can't do that unless we know how to save money and know how to generate money. So those are always the three pillars that we should always be trying to get smarter at. Getting smarter and better at making money, getting smarter and better at saving money, and getting smarter and better at investing money. Taxes is part of how we save money so that we can invest it. So how do we do that? First, how do we get better at generating income? Become really good at our job, right? It's like I have kids right now. I tell my kids, I don't care what you do when you grow up, as long as you enjoy what you do and you strive to be as good as you can possibly be at that thing. Every single one of us should be striving to be the best version of ourselves in our chosen profession. That leads to more income, right? Know what activities inside and outside of your job are income generating. We all know there's a whole ton of things that we do that are necessary, but are not necessarily income producing. The clearer we get about which is which, and the more discipline we get at putting our time into the activities that generate income, the more money we're going to create in our world. And then leverage is the third piece. Leverage is slicing off those important yet non-dollar productive activities and leveraging them to a system or a person who can do them for you so you can do more of the dollar producing, right? In any business we have, that is how we increase income. Saving money. We have to have a personal and a business budget that allows us to actually save money and that we actually stick to that budget, right? Sounds very simple, yet the vast majority of human beings, a lot of us that are self-employed, are operating businesses without an actual budget. and we're operating our households without an actual budget, right? If we're going to be serious about saving money, we have to have a budget for our personal life, we have to have a budget for our business, and we have to actually stick to that budget, right? Leverage tax strategies that allow us to keep more of our money so that we have more of it to invest and keep our lifestyle in check. The reality is the number one challenge that we have, especially as Americans, is we love to raise our lifestyle in tandem with our income. When we do that, right, there is no extra money to be able to invest, right? The opportunity to invest lives in the gap between our income and our lifestyle, right? If our lifestyle exceeds our income, then we accumulate debt. If we raise our lifestyle in tandem with our income, then we spend everything we have and we don't have anything to invest. So those are kind of the three pillars of being able to save money. And then investing is to learn, build your team, and take action, right? How do you learn? Start reading books, start listening to podcasts, right? I was blessed early in my career. I used to drive around and listen to music in between appointments. And I had a mentor, an agent who brought me into this organization who used to drop, yes, I'm going to say CDs. Some of you can laugh because it was CDs back then, but would drop CDs in my Market Center mailbox. And yes, I just said mailbox. Those are all funny words, mailbox and CDs. But she would drop coaching CDs into my mailbox with little notes. Instead of listening to music, thought you might want to learn and grow while you're driving around. Right. She kind of instilled a habit of me that when I am in a car driving, I'm typically listening to an ebook. I'm typically listening to a podcast. Right. I'm always listening to things to help me learn and grow. Right. So you got to start leaning into those opportunities to learn. And we're blessed today in that there's so many of them. Right. There's an endless supply of podcasts and webinars and all sorts of things that we can lean into, engage, and learn. Then we got to build the team around us. We need the people who are actually the professionals, right, to help us make our decisions. And again, I said at the top of this call, I don't think that negates our responsibility to learn, right? I've had lots of experiences where I had good people around me, yet I learn a new thing and go to them and say, hey, is this a thing I should be implementing? And they go, yeah, you actually should. And my question is, how come we haven't talked about it before? And I get a response, well, you never brought it up. That can be frustrating. You're like, well, what do you mean? That's what I pay you for. Aren't you supposed to bring it up? Yet we have to remember our financial advisor, our CPA, right? All of those people have multiple clients and their job is to know our business, our goals, our personal lives, all those things to the highest degree they can. Yet they are trying to understand that for a large group of people. So there will be strategies that will slip through the cracks if we're not paying attention enough to know what to ask, right? So you got to build the team and then you actually got to take action, right? My favorite saying, you guys hear me say it all the time, education without action is entertainment, right? Hopefully we're not here to be entertained. We're here to learn and take action. So let's dive into taxes really quick. We're going to talk about the very, very basics first, right? Typical expenses and deductions. This is just a really simple list of the things that we typically spend money on, right? That we're going to keep track of, hopefully in our profit and loss statement, that are going to reduce our income and create the profit in which we pay taxes on. So you have marketing and lead generation, salaries, occupancy and home office, right? Whether you're renting an office from your broker or whether you have a home office, your technology, right? So your phone, training and education, dues, equipment, office supplies, right? These are your basic buckets, if you will, right? When you're operating on a profit and loss statement, this is what we would call your chart of accounts. Your chart of accounts in a profit and loss statement is just the buckets. It's just the categories of spending, right? So you have all these as your basic expenses. Some of the key ones that there's some intricacies you want to know and understand: marketing and lead generation, salaries, occupancy and home office, and auto. Okay. When it comes to marketing and lead gen, right, this is more of a business strategy than a tax strategy, but you have to know the difference between marketing and lead generation when it comes to running your business. Somebody unmute for me and tell me what the difference between marketing and lead generation is.
To bring you leads in, what marketing is to make you have brand awareness. There's no direct there's not always a direct correlation to what you put out there.
So that's a pretty accurate answer, right? We want to look at it like this. Lead generation is proactive, outward activities that are intended to generate opportunities. Marketing is a passive approach to creating one of two things: brand awareness, or if the marketing has a specific call to action to it, i.e., there is a message in there that will cause a consumer to reach out to you directly, right? That is a more direct lead generation approach. But you have to know which it is you're doing, right? I always say lead generation is the shortest distance between you and an opportunity because it's proactive and you have more control over it. And it costs time rather than money. When it comes to marketing, depending on how you're doing it, more often than not, is brand awareness, right? It's creating, we're buying space in somebody's mindset that when they think of real estate, they think about us. If we want that marketing to be more effective from a lead generation standpoint, then it has to have a call to action, what we often call a MOFR, right? You're marketing a reason to call immediately, right? Things we need to know about marketing. Number one, any marketing we're doing, we have to understand the dip, i.e., once I start spending money, how long is it going to take? What is the reasonable time frame in order for me to expect to have a result that I can measure? The example I always use with this is farming because it's a very simple example, right? If we pick a neighborhood and we say we're going to send every month, we're going to send mailers to this neighborhood, right? Whether it's flyers or whatever it is that we're doing, neighborhood reports. If we're going to make that investment, I can tell you from past experience and all the agents that I've consulted and coached over the years, if you're not willing to make that investment for a 12-month period, you should not even start because it takes that amount of time before you start to get results. It tends to be like a hockey stick. You get nothing, 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 and then slowly, it starts to ramp up. Everything you do is going to have some dip, and you need to have an understanding of what that dip is going to be. Otherwise, what often happens is we start to invest in it. We don't give it enough time to get a result. And then we cut it off early. And all we really did is burn capital resources, right? So you got to understand the dip. Secondly, you got to understand you have to track your ROI. What am I spending and what am I making? So if I know the dip, using farming as an example, I'm going into that knowing I've got 12 months before I can really measure the results. Then I have to have an expectation at the end of that as to what is a healthy return on investment for the time, energy, effort, and capital that I'm putting in, right? At a minimum, I would argue you want to shoot for at least a 3 times return on whatever money you're spending. Anything less than that, I would argue there's probably a better strategy that you could be implementing, right? So if I spend 10,000, my expectation is probably I'm making 30,000, right? So you should produce at least 3 times. Otherwise, there's a high likelihood there's something else that you could do that is more effective. So you got to track those things.
I was just taking notes. And what is the dip?
Yeah. So what I refer to as the dip in anything that we do, and this actually shows up in a lot of different places in life and in the world. But in everything that we do, there's a period of time where it's all input and no output,
Yep.
right? So using a different example outside of business would be going to the gym, right? I always use this. Sometimes I use the analogy of sit-ups. If we could do 30 sit-ups in the morning and have a six-pack for the next 12 hours, chances are every one of us would start our day by doing sit-ups. However, in order to get abs, you have to do sit-ups over and over and over, whatever the exercise is, right? It takes a lot of effort to get the result, which is why the vast majority of us don't have a six-pack, right? Because you have to put so much effort in before you actually see the result. That space is the dip that I'm referring to. So when it comes to marketing, when I refer to the dip, it's understanding that specific strategy and typically how long does it take to get a result from that strategy. And
Okay, thanks.
you have to know and understand that going in, right? So let's shift to occupancy. A couple different ways that you can deal with occupancy as a deduction, specifically home office. So probably the most common, if you do have a home office that qualifies as a deduction, you are allowed to write off the expenses associated, the percent of expenses associated to your home that your home office takes up. So the way I just said that sounds very confusing. Put simpler, if your home office takes up 10% of the square footage of your home, then 10% of the expenses involved in running your home can become tax deductions, right? So those can be things like mortgage, interest, rent, utilities, landscaping, security. All of those things can potentially become deductions. Again, every single thing I say, talk to your CPA. The CPA is the professional. Your other option when it comes to home occupancy is they have a minimum deduction where you can take a price per square foot and take a flat deduction. You're typically going to do much better as far as percent of square footage and a percent of home expenses, which is the second bullet here. But those are your two options when it comes to writing off occupancy, specifically home occupancy. Alan, what do you got, brother?
Hey, sorry to interrupt the conversation. Just wanted to mention this, something I learned recently. Check with your accountant. I'm not an accountant. I'm not an attorney. I'm not a doctor. I'm not, well, you know, all the things I'm not. But check with your accountant. And that is, you can deduct the common area in your home, hallways, stairways. So don't just go off your total square footage. Deduct the common areas. You're reducing the denominator, right?
Exactly.
Which means instead of your office being 10% of or 1,000 feet based on or 500 feet based on 2,000 feet, you've reduced the 2,000 down to 1,500. And so now the amount of space, the percentage increased. Just a small thing, but it's all small things.
Well,
If I
I love the way you ended the statement. It's a small thing, but it's all small things, right? You got to remember, like, everything from expenses to income to wealth building to it's all a raindrop in a river. And we know that raindrops can cause a flood, right? Like, it's all the small things on top of each other that create the big result, time on task over time. Go ahead, Michael.
Years ago, my sister had her own business and was advised to really avoid the home office because it's a red flag for Uncle Sam or the IRS.
So I'm gonna say every statement with the caveat, I'm not a CPA. I
Mhm.
personally disagree. A lot of people will avoid deductions, and their reason for avoiding those deductions will be it's a red flag.
Yep.
It's a non-issue when you do it correctly, right? So
Right.
there are certain things that when the IRS sees them, they might make your file more likely to be audited.
Hmm.
But that's only a problem if you didn't do what you did correctly.
Right.
Right? So sometimes I have heard that advice. I wouldn't do that because it tends to be a red flag for the IRS. And my answer is, am I doing anything wrong? And if the answer is no, my answer is, well, what am I worried about an audit for? Like, I want the money that belongs to me. And if
Right.
that means I have to get audited later, I'll take the audit later as long as I know I'm doing everything correctly. So you will hear that for different deductions at times. And by the way, with CPAs, different CPAs are comfortable with different things because there is some gray space within tax code.
Right.
So you got to find a CPA that lives in the space that you're comfortable with, right? You should never go into black and white and break
Yep.
rules. But if you're doing things and doing things correctly, I'm more concerned about minimizing my tax bill, maximizing the capital I get to keep and reinvest. And as long as I do it correctly, I don't fear an audit. Karina?
My uncle's he's an IRS guy, and he says that it's not the office that it's the trigger, it's the occupation and the office. So if you're like a real estate agent and you have an office at home, that makes sense. but if you are like, say, a waitress or something like that, and you're taking a deduction of a home office, that those two things may not jive together unless you have something additional in there. So it's not the office, it's the occupation that's connected to the office.
That makes sense. Yep.
Exactly.
So
It does make sense. Yep.
let's talk about auto real quick. We're not going to spend too much time on this, but again, you've got two different options. This I will say, so you have a mileage deduction. That is one of your options, and then you also have the option to take actual expenses. I will say this: when an audit does happen for a real estate agent, one of the number one areas that you are likely to have a problem if you are audited and owe taxes on is mileage deduction. When you are audited, they are going to look for a record of the mileage. And if you do not have that to support the deduction you took, then you are likely going to have an expense involved in that, right? They're going to look to recapture the taxes that were owed plus penalties if you can't prove that that mileage is legitimate. That means one of two things: you keep a log in the car, or you use a modern tool like Mileage IQ that tracks all that stuff for you so that you have a report, right? It's the folks that are going out into their driveway when they're getting paperwork ready for a CPA, looking at their odometer, guessing what it was last year, and picking a random number with absolutely no documentation, right? That's a non-issue until you get audited. You get audited, you now don't have the supporting documentation, and you have a problem, right? So we're typically going to get the highest deduction using a mileage deduction. However, you need to make sure that you're tracking it so that if you do get audited, you do have the documentation, right? Some other things to talk to a CPA again, not a CPA. When you're purchasing a car, right, there can be deduction advantages based on the type of car that you buy, right? So I believe it's vehicles over 6,000 pounds. You can take a lump sum deduction when you purchase that vehicle. That can be a very strategic decision to make. So all of a sudden, when you're shopping for cars, you might be looking at two different models. The size of that vehicle and the weight of the vehicle could make a massive difference to your tax bill and might be the deciding factor as to which vehicle you choose to purchase. So that's another thing you want to think about when you're thinking about automotive deductions. Okay. Next thing I'm going to talk about, slightly more advanced tax strategy. So self-employment taxes. Some people realize this, some people don't. But if you have a regular old jobby job, you go and punch the clock, you pay taxes. You may or may not know, you are paying half the taxes, your employer is paying the other half of the taxes. Us, as self-employed individuals, we have the luxury of paying both the employee side and the employer side because we are self-employed. So they call it a self-employment tax. Since there is no employer to pay the other side of the taxes, we pay both sides of the taxes. However, there is a tax strategy. You have to talk to your CPA. Whether it makes sense to do this or not does depend on your income. So again, you want to talk to a CPA and strategize when does it make sense to do this and when does it not. If you are operating as an LLC, that means it is a pass-through entity. LLCs don't pay taxes, the owners do, right? So that business that is held in an LLC makes $100,000. That $100,000 passes through onto your personal tax return as income, and then you pay taxes on that $100,000. There is a mechanism that allows you to operate as an LLC, but elect to file taxes as an S corp. When you do that, you have to pay yourself a reasonable salary through a payroll company and pay taxes on that income. The example on the screen shows the outcome of that based on a business that's netting $300,000. So on one side, you have someone just operating as an LLC and paying the pass-through taxes, $300,000 net profit, taxes are $84,000, $87,000 in self-employment taxes, total liability is $92 and change, their after-tax income is $207. The other side, $300,000 in net profit, They pay themselves a reasonable salary, 50,000 in this example. I don't know why I did quotes when I said that. You pay employee taxes on the 50 of 74 and change. The remaining taxable income is 250 because you took that salary as an expense. So now you have 250,000 left. The remaining taxes is 55. You just took your tax liability from 92.7 to 62.2. Right? So you look at the two incomes afterwards. After tax income on one side is 207 and change compared to 237 and change. And all we did is file a piece of paper with the IRS and then pay ourselves a reasonable salary. And that is the net result, right? These are the little strategies that make a big deal over time. In this example, that just put a significant amount of extra money in your pocket that you can turn around and put to work for you to start generating passive income and wealth for you. Any questions about that piece?
I just saw some stuff in the comments. What is the app that keeps track of mileage? And David White said Mile IQ was one of them.
Mileage IQ is the one that I'm aware of. Yeah. All right. This one, the leveraging nepotism. So this is for all of us who have children. You do have the ability to pay your children, right? So if you want to take a screenshot of this, if you have children ages 7 to 22, each of your children can be employed by your business and paid an annual wage of $12,000. Okay, that's an important number because it is the standard deduction amount for a single individual. Your business gets to take the deduction for the payments that you're making to your child, thus decreasing your total income for the business. Your children will then file their own tax return, and since they only made $12,000, they pay no federal income taxes because of the standard deduction of $12,000. So you have them do work, and by the way, they have to actually do work. You can talk to your CPA and they can give you a whole host of things that they can be doing for you, but they have to do work, and you need to keep some form of record of the work that they do, once again, so that if you get audited, you can prove that they are doing actual work for you. But for every child that does that for you, you're reducing your income by $12,000, and that becomes tax-free income for your child. The business gets to take the deduction, but the kids pay no federal taxes, right?
I got a question in the chat from Rosie. She said, how do you document the payment?
So the payment is going to be documented through your profit and loss statement, right? So as long as we're keeping a profit and loss, that piece is a non-issue. And the more important thing is documenting the work that they are doing, so that if, in fact, you are ever audited, you can say, here are the things they do for my business, right? So I was talking to a business owner recently who I shared this with, and they now have their children coming in and doing all the janitorial work for the business that they own. They come in and they re-up all the supplies, clean the facility, do all the things. They keep track so that they can prove that that work is being done. That allows them to take advantage of this and know that if they're ever audited, they can back up the fact that it is legitimate. This can also, now, by the way, the money does have to go to your children, right? So what some people do is they'll open a bank account for their children, right? Like I use the example, my children ride horses, right? All that money could go into their bank account and they could pay for, say, their lessons, or they could pay for their horse's board, right? Now that's an expense that I personally would have taken on regardless, that they are now paying themselves that expense, but they're paying it with tax-free money. Right. So every dollar I am able to avoid taxes on, right, I'm up by whatever my tax percentage is. You can also combine this with an IRA and 401k strategies, right? So you can maximize the benefit. So you can also pay your children this salary. You could put $6,000 into an IRA, right? That expense is deductible, and you can use the standard deduction to take the tax liability down to zero. And now you're allowing your children to actually build an investment account with pre-tax money, right? So there's advanced strategies that you can implement there as well. Okay.
I got some more questions. I have another question that says, are there app or worksheets to keep P&L? And the other one was, do we have to issue a W-2 to the kid at YE? Any advice on how/where?
So I believe, yes, you do issue them a W-2. What was the other question? Is there a what?
The other question was, the first one was, is there an app or worksheet to keep P&L?
Keep a P&L. So there's a few. You can use QuickBooks, Quicken, any of those. Guilty Pitch. I own RE Profit, which is a software program built specifically for real estate agents that automates profit and loss and budgeting. The reason I built it is because I've been teaching this type of content for almost a decade now, if not a decade. I always try to teach tactic tool. And that is the one area where I never really found a simple tool to allow you to do that, which is what led me to build RE Profit. If that is something you're interested in finding more information, just put something in the chat, put your email in the chat, and I can follow up with you. That is a simple web-based and mobile-based app that will do budgeting and profit and loss for you. Again, outside of that, the best answers I have for you on the business side would be things like Quicken's, QuickBook, all those kinds of things. In my opinion, those platforms are more complicated than what we need. So a simpler, more automated platform works a lot better. Obviously, I'm biased. I think RE Profit does a really good job at that. Those are the ones that I'm aware of.
She also wants to know, where can we generate the W-2 form or from?
So the only answer I have for that, and somebody else is welcome to jump in. I have people who do it for all my businesses, so I don't know specifically how they do it. I don't believe you need a CPA to do it. But I couldn't actually tell you how the W-2s are generated, because for each one of my businesses, I have somebody who generates those W-2s. Does anybody have a better answer than that who can chime in? And
IRS.gov.
IRS.gov.
Yep.
There you go.
It's on the forms tablet.
There you go. So IRS.gov, go to the forms tab, and you can find what you need to be able to do that.
Matt, quick question, if I can, for clarification. So I know you indicated IRA. Isn't it almost feel like a no-brainer that you would, at 12,000 or less, go with a Roth IRA, custodial IRA in whatever vehicle, since there's no additional tax benefit?
I mean, to me, I would say yes. And I always am going to put the caveat, talk to a financial planner in that case. But yes, that would be my opinion also. Yeah. Which, by the way, for those of us who have children, right, if you look at somebody help me out. I'm having a brain cramp. Berkshire Hathaway, one of the wealthiest investors. Buffett, thank you. Jeez. Warren Buffett. Warren Buffett is one of the wealthiest men on the planet, one of the most successful investors in the planet. And if you look at the time frame in which the majority of his wealth was built, one of the biggest advantages Warren Buffett has over any other investor is the amount of time he was invested in the markets, right? He started very young, and with all due respect, he is very old now, right? So he has a massive advantage over other investors in that he has been in the market for an incredibly long time. If you use these types of strategies to get your children in the market at young ages, the compounding effect of that is life-changing for them, right? So it can really be a big deal as far as the legacy that you leave for your children and the impact that it will have on them when you implement a strategy like this that gives you a tax benefit and gets your children into the market at a very, very early age. Okay, we're going to shift to investing and how that can affect your tax strategy as well. So investing for cash flow and deductions, understanding how depreciation works. Most of us, because we're in real estate, I hope understand this, but if you're looking at residential real estate, the government allows us to pretend that real estate is going down in value as it gets older, even though that is typically not the case. So they look at a piece of residential real estate and they say the life expectancy of that real estate is 27 and a half years, right? How that works is you take the actual property value, you subtract out the land because land does not depreciate. That remaining amount of value gets divided by 27.5, and that is what you are allowed to deduct in the form of depreciation on investment properties on an annual basis, right? This is a big part of what makes real estate such an amazing wealth building tool is one, we get to take possession of the asset for a fraction of the cost. Right? We can get into a piece of real estate as low as 3.5% of the value, up to 25 to 30% of the value. You get full control of the asset for a fraction of the value. Then we can rent it and have tenants pay the mortgage for us. The money we bring in above and beyond is cash flow. Then on top of that, we hopefully have equity. The property is appreciating in value, and the government allows us to take a deduction as if the property was going down in value. Okay, so that's depreciation at its most basic level. These are just some rules that talk about some of the details of depreciation with respect to cash flow investment properties. The thing you need to know is there are limitations, right? So there are some rules around depreciation that basically say you cannot shelter active income with passive deductions, meaning I am a police officer for a living, that is active income. I own investment property, which is passive income. I cannot reduce my active income with passive deductions as a general rule. Okay. There are some rules around. The reason for this is there was a period of time in which very wealthy people were buying real estate for the sole purpose of racking up depreciation and completely eliminating the taxes on their income. Okay. So now there's some more complicated rules around it. And the more money you make, the less you are allowed to leverage those deductions. However, there's an exception to the rule that if you meet certain criteria, you are allowed to shelter active income with passive income. Those rules generally are what you see on the screen here. You work in a real property trade. That would be brokerage, development, redevelopment, construction, all those things I have listed on the screen. If you fall into that bucket, please put your hand up. That should be everybody. I only see 3 of you, and 1 of you have your hand up, which means the other 2 are not familiar with what they do for a living. That would be all of us. Second is you perform at least half of your personal services for the year within the real estate trade. If you fall in that bucket, you see a hand. Okay, some of us still know what we do. Some of us are still confused. The last one is you work at least 750 hours a year, which would be 15 hours a week in a real property trade. When you check those boxes, those limitations go away. And it essentially means you can shelter 100% of your active income with passive deductions. So the reality is, if you are a full-time real estate agent and that is your bread and butter and how you make your living, you check those boxes, and we have an advantage over some other individuals as far as the degree to which we can reduce our income with depreciation. So it is a really, really big deal. Very big deal. Okay. Let's skip all these details for a minute and let's talk about this. So investing for cash flow, depreciation, there's a thing called cost segmentation. We're going through this quickly because we have an hour, and right now we have 16 minutes left. Cost segmentation for a really long time was predominantly used in commercial real estate, very common in commercial. So when we go back and say a residential piece of property is depreciated over 27 and a half years, that 27 and a half is the IRS saying all the different components of this real estate have a different shelf life, but it averages out to 27 and a half. Cost segmentation is when you have a special appraisal done where they break the property into components and say, well, this piece of the property has a shelf life of 27 and a half. This piece has a shelf life of 5 to 7. This piece has a shelf life of 15, right? What it allows you to do is accelerate your depreciation, right? Doesn't mean you get more. It means you get more of it up front. And if I get more of it up front, it means I get a bigger deduction early, which puts more money in my pocket now, which then lets me put that money somewhere where I can get a return on it. Now, this kind of like the gentleman who said, so-and-so said, this is a red flag for the IRS. I don't like to take this deduction. A lot of times I'll hear people go, well, I don't want to accelerate my depreciation because if I sell, I have to pay more back. I mean, that's an accurate statement. Or they'll say, I did this, but now my tax deduction every year is smaller because I took so much of it up front. That is 100% correct, right? The bucket you get to depreciate is the bucket. When you do a cost segmentation, you're just accelerating it. Again, so you get a bigger deduction early, which puts more money in your pocket today, which is smart as long as you take that extra money and go put it to work for you. Now, this is where it gets really fun and funky. There is a thing currently called bonus depreciation. What bonus depreciation allows you to do is you go get that cost segmentation done. And once you have that, everything that fits into a non-27.5 bucket, so it fits into the 5 to 7 or the 15-year bucket, whatever fits into those buckets, you get to take as a lump sum deduction. Now, as of 2022, you got to take 100% of it as a lump sum deduction. A real life example, $345,000 property, cost segmentation, bonus depreciation was $80,000 in change, which meant that $345,000 property created an $80,000 deduction, which reduced my income by $80,000, allowing me to not pay taxes on that $80,000 that year. That's a really big deal. Depending on your tax bracket, if you put 20% down on that property, you essentially just recouped 50% of the money you put down on that property from that deduction, right? Now that was 2022. That bonus depreciation is fading out. So 2022, you could take 100% at once. 2023, 80%. 2024 was 60. For 2025, if you do that cost segmentation and do bonus depreciation, you'll be able to take 40%. Right. So for simple math, if 100,000 landed in those non-27.5 buckets in 2025, currently, you'd be able to take 40,000 of that as a lump sum deduction. And then the remainder you would take based on the depreciation schedule of 5 to 7 years or 15 years, depending on the bucket. In either case, you're fast forwarding those deductions, putting more money in your pocket today so that you can put that money to work. There is a bill that has been bouncing around for a long time. There is talk of bonus depreciation being reintroduced, where this may be expanded. Given the results of the most recent election, it is even more likely that that could happen. But as of today, this is what it is, right? That could change in the near future. But as of today, 2025, you can take 40% of bonus depreciation as a lump sum. Next year will be 20. And if Congress does not reenact something, it will fade out completely in 2027.
I have another question in the chat. It says, who does a cost segmentation study on a property?
Sure. So there's two ways you can do it. You can hire an appraiser who actually knows how to do cost segmentation. So there's appraisers that you can hire. who will come in and do a cost segmentation appraisal, and you will pay them for doing that. There are also online platforms that you can use in order to do that breakdown. One of them, I believe, is, I want to say it's DIY depreciation. Let me check something real quick. And this is not me pitching any of these, but I believe I have a pretty weak signal right now. Let me see. I'll tell you what I will do for you guys when I send out a follow-up email with this recording. I will include that. Again, this is not me pitching them. I just know they exist. I believe there's a couple of them that are out there, but one of them is DIY something. But I will find it and include it with the notes when we send out the recording. So it's either an appraiser who knows how to do, who is trained on doing a cost segmentation appraisal, or you do have online services that will do that for you. You then provide that to your CPA, and then your CPA includes that in your tax filing. And also remember, it's just like everything else with taxes. If the day ever comes that you are audited, it is one of the things they will look at to ensure that you did it correctly. As long as you did, you're fine. If there was an issue, mistake, error, anything like that, that is where, there may be a challenge and there might be some money owed from an audit. So number one thing, just make sure that you hold on to any documentation that you used in order to do bonus depreciation. Any other questions, Victoria, before I move?
Hey, Matt, can I jump in for a sec?
Yep, go right ahead.
One clarification on cost segmentation. If it's a simple property like a small multifamily or something like that, the way my accountant's always done it is, and forgive me if I didn't listen if you said this already, because I might have zoned out for a moment. But that said, what they would do is they would look at land versus, they always on the field card, there's always land versus building value on the assessor field card. So if you take the land versus the building and you know the total valuation there, all you have to do is see what value they assign, take the land value, divide it into the total value, and now you know what value they've assigned to the land. So it's super straightforward. Like as soon as you just grab this year's assessor card and then you're going to take that number and use that percentage for the 27.5 years. So you never have to do it again after you've created it once.
Correct. So for standard depreciation, that is exactly how it happens. You're going to subtract out the value of the land, and then the remaining amount gets divided over the 27.5, and then that deduction gets taken each year for as long as you own the property until it's fully depreciated. If you're doing bonus depreciation, they're just going a step further. They're pulling the land out, but then they're pulling the building apart and putting it into one of three buckets: 27.5 bucket, a 5 to 7 bucket, and a 15-year bucket. Yeah, so that's accurate. Anybody else? Okay, another little fun nugget. This is more probably, well, I'm going to take that back. I'm just going to tell you what it is. So the Augusta rule is a fun and interesting rule, right? So what the Augusta rule says is Internal Revenue Code allows homeowners in any income bracket to include up to 14 days of rental income from their taxable income. This is for your primary residence. So what the Augusta rule basically says is that you are allowed to rent your primary residence up to 14 days out a year, and the income that you receive from doing that is tax-free. An example of how you might use this, you have a team and you host team meetings at your home. You host business planning meetings at your home. Potentially, again, all of this, talk to your CPA. You have client appreciation parties at your home. What you have to do is you have to research what would it cost for me to rent a similar venue in that area, and then you charge yourself that reasonable amount. It has to be commensurate with what you would actually pay if you rented a similar facility. But when you rent your own home, you're allowed to pay yourself, and that income becomes tax-free, and you're allowed to do 14 days a year. So the reality is, if you do your homework and say, okay, in order to rent a similar facility in the area would cost this much. I have 14 events a year that are a combination of business planning, team meetings, and client appreciation. I charge myself, right? Matt Erdmann charges Matt Erdmann's business X amount of money. In order to use that facility, that income essentially goes from the left pocket to the right pocket and becomes tax-free, right?
It looks like Alan has a question. He said, does the Augusta rule apply to second homes in addition to primary residence?
So my understanding is no. I have had some people debate that with me, and I am 99% sure the Augusta rule only applies to a primary residence. And again, you take all these things and you put them together. There's another presentation that I do where I take an agent's business, two agents who are running real estate businesses that net the same amount of money. And then I literally slide by slide, I put in all of these strategies, right? So as I go through the presentation, on one side is the agent who's implementing all these things. It starts out with they have a budget and a profit and loss, so they're actually operating at appropriate numbers and have a 40% profit margin, right? And then we go to the next slide. They implement the tax strategy of having an LLC and filing it as an S corp. And then we go to the next slide and they implement this strategy. And then they go to the, by the time I get to that end, at the end of that presentation, the wealth gap and the income gap between those individuals over a 3-year period is massive, right? And I do that presentation to drive home how all these little things add up to create a massive snowball. And when you take two individuals who are running a business that generate the same amount of profit, one implementing all these things and one not, literally within a 3-year period, you have two individuals that have two businesses making the same amount of money whose worlds are entirely different. And it's just, again, it's a raindrop in a river. It's just doing a lot of smart things that little by little, they all add up. And the difference is massive, right?
Matt, quick thing. If I, online, we'll show you all sorts of things. 5 different websites seem to support a vacation home you own, but not investment properties as also for that Augusta rule.
Okay, so that might be accurate. That might be accurate. I know you can't do it with like traditional rental properties. So second home, that might be true that you can do that. So do your homework, ask your CPA, right? That's also a great advantage. If you do have a second home that's a beach home, a property like that would rent for a significant amount of money in order to host an event. Now, all of a sudden, you can use that property to host events and create a pretty significant tax savings.
Someone said, if you do the 14-day rental, will you have to pay capital gains tax when selling?
If you do the 14-day rental,
will you have to pay capital gains tax when selling?
So to my knowledge, those two things are completely unrelated. You will pay capital gains on the sale of your property when you sell it. Obviously, there's rules around that. Primary residence is different than residential. We're allowed to net a certain amount of profit, whether we're single or married, on a personal residence before we pay capital gains. When we're selling rental property, we're always going to pay capital gains. We're also going to there's also a depreciation recapture, right? So what you do want to do if you're selling an investment property, that Augusta rule is not related. But if you're selling an investment property or thinking about it, the smart thing to do is call your CPA and say, I'm thinking about selling this property. I believe this is what it would sell for. Can you run the numbers for me? And they'll go in and they'll look at your depreciation recapture and what your capital gains would be. And they'll give you a fairly accurate estimate of how much of that money you're going to be able to keep when you sell that property, right? And then you have to make decisions like, am I going to sell that property and keep the cash? Or am I going to sell that property and 1031 exchange it into another property, in which case I don't pay taxes. I roll the depreciation recapture and the tax liability into the next property, right? So it doesn't mean it went away. I just kicked the can. The liability is still there. The depreciation recapture is still there. I just took it out of this box and I put it in this box. That's what a 1031 does for you. But if you're thinking about selling an investment property, the best thing you can do is call your CPA and say, I'm thinking about selling this property. This is what I believe it would sell for. Can you run the math on me? They'll run depreciation recapture, capital gains on numbers for you and show you this is what you're going to end up walking away with once you sell the property. What else we got?
Maybe not so applicable for people who are real estate professional statuses, but maybe helpful for clients that are looking to invest in the short-term rental space. There is from what I've heard, they're taxed more as like a hotel. So without being a real estate professional, you can do a bonus depreciation on a short-term rental investment without being a real estate professional.
Yeah. Yeah. And by the way, to Patrick's point, knowing and understanding all this stuff makes you a much better real estate agent, right? Because you can have a higher level of conversation with individuals about real estate as a wealth building mechanism, right? So the more you know and understand about all these things, the more valuable you become to the people that you're serving when you go to work every day. Right?
There's another comment. Someone said, can you repeat, was that a 1031 exchange or 1031?
1031 exchange.
Yeah.
We did do a training on that, I don't know, probably 6 months ago. We had a 1031 facilitator on one of our webinars. That's probably something at some point I'll recycle. There's certain topics that I always bring back. This time of year, I always do tax strategy. 1031 exchange is a very relevant topic. So I usually do that at least once a year, if not twice a year. But we did run a webinar on that probably 6 months ago where we had a facilitator on and they went into all the details of how 1031's exchanges work. Again, as real estate professionals, that's a thing we should understand. That can have a massive impact for our investor clients, as well as if we have clients who might be a little further along in life, own multiple pieces of real estate, and might be thinking about how they're going to pass some of their assets and wealth on to their heirs. Knowing and understanding those things becomes really valuable because they can become part of their legacy strategy. So, all right, that being said, we are 4 minutes over, so I hope this was super helpful for everybody. We are going to be back next week. Next week, we have a guest. We're going to have an agent who is one of the #1 agents in their entire state, does a tremendous amount of business, and their absolute core lead gen funnel is sphere of influence. And this individual does it like nobody else. Not only are they one of the top agents in the state in which they operate, they're involved in new construction, real estate investing, all sorts of property management, all sorts of cool things. And this person rarely leaves their zip code. That is how niche-y this individual is. Literally rarely leaves their zip code, but completely dominates the market that they work in. He's going to be on next week. We're going to interview him. He's going to talk about how he built his business, what his strategies are, how he got that level of market share, all of those things. We're going to be able to pick his brain and learn from him. So hopefully everybody can join us for that next week. That being said, hope this was valuable for everybody. We will see you next week.